Good morning. I'm Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Alix with the Street, and together we bring you Morning Call Express. Scott, stocks got really hammered on Monday. S&P closed down almost 2%. How much damage has been done over the last almost week now in the markets?
I think there's been a lot of damage done starting last Wednesday. Last Wednesday, you had that last constructive pattern, that wedge-type pattern that resolved to the downside. Since last Wednesday, we were down 5–6%. So yesterday was an opportunity we talked about for shorts to cover because they made a nice amount of money and they shouldn't be pigs. Take your trade just like anyone else. And if you're looking to get a little long, could be a decent spot. I was talking 1185 to 1195 as a zone that has held since last October.
So let's look at the chart because I want to see if the rally that we're seeing this morning is sort of just a relief rally, an oversold bounce, and then we're going to resolve to that downward trend, or if it has a little bit of legs here and you can add more longs.
I think yesterday we have a new point of reference, and I'm going to show you the chart of the spiders because that's actually what I bought yesterday, and I want to show you where we can go pretty easily. You know, I want to break out my fancy Fibonacci retracement because we've had it the entire time, right? We started down here, and if you go all the way to the top of this rally that took place all the way to 1292 in the S&P, you will see that we held yesterday the 50% retracement zone. The 50% retracement zone, we came off that low, and I do think that we could rally perhaps to fill this gap, the 50 days around 120.92, maybe with a little extra excitement if we don't get any crazy headlines into Thanksgiving or even Friday, maybe we get back to 122. But this is probably where I think we can go. And as far as Fibonacci retracement zones, okay, let me tell you what they mean a little bit. We had that 25% retracement zone that we held the entire time. So from the low to the high, we never violated. So you saw a lot of pent-up energy. You saw a lot of shorts trapped, a lot of people trying to chase the market. Then those two distribution days we had, we went to the 38.2% retracement. The trade slowed. The speed changed. And now at the 50% retracement zone, some would say that the macro rally is still intact, but there's just a lot less pent-up energy. You have to expect a lot less. You have to take trades, and it'll be a lot slower of a scenario to the upside, especially.
Providing that we do hold that 50% retracement, though.
Yes.
Yeah, okay. If we don't, then it's a game changer.
Well, then there are new points of reference to look at. Maybe we get back down to those lows. But for right now, that's like the last little thread for the macro trader. For momentum, out of the market. For trend traders, somewhat out of the market. They're just picking spots. But for the macro trader who need to put long-term money to work, they probably put some money to work yesterday.
So would you be adding more positions today? And what sectors are kind of holding up the best? I mean, they all got really hammered yesterday.
Intraday, I will try this. So if you go back to the chart of the spider, let me show you how I would add. Because I took some spiders home yesterday. What I would do is, we're opening up a little bit. We're opening above 120. If we start to get above yesterday's high of about 120.35, I will go from a tier 1 to a tier 2 just for a trade intraday. And then I probably, once we head up to the 50-day moving average, take at least a tier off. So that would be about 60 cents on top of what I'm up overnight. And then see how we handle this 50-day. If we blow through it, maybe I sell a little bit more as this gap gets filled. But if we go up to the 50-day and fail and just come right down, then all of a sudden that little cash flow trade is over, and you can do the same thing. There are a lot of gaps in a lot of charts from yesterday. So what you do is if you are long versus yesterday's lows, when those stocks get into those gaps, figure out how much of that gap it gets filled, and that'll give us a little indication or some clues on how weak this market really is. Because if none of these gaps get filled, we're that weak. If some gaps get filled and push higher, there might be a little bit more room for some trades.
All right, we don't have a lot of time, but I want to hit on maybe one sector that you're going to be focusing on that held up better than the rest.
I'm going to be probably looking at the high beta stocks. They haven't held up the best, but they could have the most movement. So if you look real quickly at the Qs, you will see that they did come off the lows. They did somewhat hold the 50% retracement also. If you look here, you have a decent move off the lows, same type of scenario. If it goes through yesterday's high, I want to see how much of this gap gets filled. I'm going to focus on some of those high beta names,
right,
like Apple.
Right. And also, not to mention, if we go away from Apple for a second, like NVIDIA and KLAC and VMware were one of the few that did really well yesterday. So I wonder if there are some trading opportunities there and not just in Apple.
Yeah, those are the ones that went green. I think NVIDIA had some news yesterday that they were going to be included in the MacBook. It went green first, gave you a follow-through. That was a good trade.
Unconfirmed.
Okay, yeah,
but
rumors,
still, okay.
but there was some action there. VMW, there were no rumors, but it went green first. So we'll see if there's any follow-through there. Some guys who play momentum probably took VMW home because it was strong. So yesterday, in the face of a lot of red tape or a lot of red arrows, you saw some things turn green, and we'll talk later on how to make money with them just in case they show more relative strength as we move forward.
And then really quickly rounding out, just in terms of gold, got hit again with the market. It was saw the need to liquidate yesterday, but physically gold's holding up really well. I mean, the GLD saw less than 2 tons of outflows. We saw ETP products last week. Inflows were about 1.5 billion. Would you be adding a little bit here?
Let's take a quick look at the GLDs and see where we're at, because I've been watching it, somewhat slow, somewhat closely. It's just right now, I guess. Some people went long versus this last breakout. I did not. It's still holding above one of the major moving averages. So I would say you have a bit of room to maybe get back to this 166 area, and then you're going to have a real big wall of resistance right around 168. At this point, I think a lot of momentum left. The gold and GLD when this range or this wedge, just like the market, resolved to the downside, but overall still holding major support and a moving average. So just be a little careful. Don't expect too much here.
All right, and if you want to know more about gold and other stocks that Scott's going to be trading today, you can join him for the entire morning call on the street.